Okay guys, hope you're well. Got my coffee, got my thinking cap on, and I want to kind of give you an exercise to work on. It's kind of inspired by a few emails I've had this week. And there's a general consensus across what I get. And it's always quick money and the easy route. Well, there's no quick money and there is certainly no easy route. You have to put the work in. It's that simple. All right? If you're not putting the work in, you're not going to get anything out of it. And I can't be any blunter than that. And all you'll do is you'll just throw your money away. All right? You need to start looking at it constructively. And a way to do it is the 30-day challenge. Now, the 30-day challenge is very simple. I kind of alluded to it in the video I did yesterday where I gave you guys the quick compounding sheet. Now I'm just going to go through it and explain what the 30-day challenge is. And it will help you, especially if you've got small balances and sort of limited patience, shall we say. Because it will force you into thinking about what you're going to do. And it'll also kind of teach you patience. So what does all that mean? Well, the 30-day challenge is it's one trade per day for 30 days straight. Okay. And the idea is you're looking for a single win of 10 pips. 10. That's it. All right. You start with a small bid size, and each time you win, you move up. Next time you win, you move up. So you're kind of working your way through the levels, if you like. But in the process, you're building up your pot to turn a small amount into a reasonably large amount. And in the process, you have to document it and you have to keep track of what's going on. So let me show you. So I think most people can put 300 quid into a trading account, just £300. Now that's essentially half of what I started with many moons ago. Well, not a lot more than that, but I just fucked it up. But that's life. We all blow accounts, we all make mistakes. But when you're starting out, start small, but think subjectively about what you're doing. And what I mean by that is slow down. Just don't take any signal. You've got one shot, the golden shot. So you be patient. You're a sniper. You're not doing a shotgun. So with this, what you would do is you would start with your £300. Just drop that into there. Yeah. See, auto calculate. So it's £300. Why 300? It's just because it can open up major markets, i.e. cable, FTSE, euro, dollar, reasonably safe, and give you enough wiggle room that you're not going to get a margin call if it does go against you. And if you're trading gold, for argument's sake, you have more than enough room to sort of have wiggle room. All right, so it's just a reasonable amount. If you go below that, you're going to find that you probably get margin calls quite a lot. All right, you put in there what you want to start with. Now, depending on your broker, you start with the minimum bid size you can. Now, if you're on sort of, well, the 5%ers will go down to 10 pence. BlackBull, it's pretty good with its price per pip. Trade Nation are pretty good. There's a load of them. We'll have micro lot sizes. All right. I'm basing this on my main broker, and it's for cable 50 pence. All right. So it's 50p a position. All right. So that's what you put in there, and it puts it straight into here. And now this lot will start auto calculating what they are. All right. You put in the increase. Now, again, this is up to yourself. You could move it by 5%, 10%, 20%, whatever you choose. But 10% is reasonable. Why? Because on 50p, it is 5 pence. Nothing. All right. So it's a small amount. Okay. And you're doing it once a day. Your risk factor depends on your tolerance. Now, when you're first starting, obviously you've got no other choice but to take risk on, is what I'm saying. If you put this into 2%, which is the industry standard, personally I disagree with it. I think risk should be what your pain threshold is. That gives you a 12 pips stop. Alright, fine. But what about if it spikes? So what you would do in this instance, I would mark on the chart where 12 pips is, just a line, set this at 5%. Okay, so it's giving me some wriggle room, you know, I've got 30 pips to play with. But the second that passes that line that I've drawn on the chart, I have to make a decision. And that decision is whether or not I'm going to kill it or just weather it out. All right. And why is that? Because of wicks. And the way I would work it out is very simple. If it wicks through and then closes above the line, fair enough. It's just a wick. But if it closes below the line, I would then need to start thinking to myself, I am wrong. It is time to kill. And you're better off killing and losing, I don't know, 10 quid, 9 quid, whatever it happens to be, than letting it run all the way down. All right. Your stop is only ever there to protect the account. That's its job. It is not part of the trade. It is there to protect the account. End of. The trade is you and the end post. Okay. So that's kind of the way I think of things. You set yourself a mandatory target of 10 pips. All right, which is here. As soon as you've hit your 10 pips, you're done for the day. And it'll work it out. So that is there. It's telling you what the baseline is, where you're starting, and where you're going to end. Now, for argument's sake, you do have slippage. You can have positive slippage. You can have negative slippage. Now, sometimes the market might cash out at 11 pips. So you put on the end what your actual balance is. Or you may be waiting for the candle to close, and it might close at 12 pips, just depending on what your style is. All right. So the idea is 10 is your benchmark. As soon as it goes past, you're pretty much done. All right. So say you got 307, it will come across, and the idea is to keep this in the green for 30 days. All right. So the next day you come into market, it's telling you your 55p. It's telling you what your risk is. It's also telling you how far the pip count can be. Now again, you can adjust this to suit yourself. All right. This part here is just a guide. You're interested in the win. All right. Today you come in and you've got 315. Just for argument's sake, you just put in the real balance there. All right. And as you see, it starts counting down. If you get it wrong and you lose, so today we've gone back and I've lost 15 quid. All right. It's gone back to 300. And as you can see, that 300 is in red. Okay. Actually, what I'll do is I was going to make that brighter. No, I'll leave it alone. It's fine. Just leave it in red. I'll make it so that that stays white if it's 0. Make it a bit easier for you. You step back. Okay. So you lost 15 quid on that deal. All right. You count back 15 quid's worth of profit. So you would actually be going back to the start, 50. And all you would do on your next trade going forward, which would be here, just so you can keep an eye on it, just key in 50 and it will start the process again for you. All right. Just stops you over egging the account. All right. Hope that makes sense. And then on this side, all you would do is just put some basic notes in. Completed. Footsie. I worked on the 1 hour. In a good mood. And then whatever other notes you want to add into this. If you feel, which would have been this one, just put no, wasn't completed, because you didn't complete the trade, you lost. And then put in why you lost, you know. Did it hit the stop loss? Did you get the market wrong? All of this. And do it for 30 days, once a day. And at the end of that 30 days, you probably taught yourself quite a few lessons. So what I'll do is, just while I'm rendering the video, I'll make that so that it stays white. Okay, very, very simple. Okay, and I'll send up the sheet for you, and we'll be able to talk through this throughout the month, and hopefully we'll get you on that journey, because that is my sole intention. I want you to be better. Okay, so catch you soon, guys.